#sector rotation to outperform the market. Most investors are leaving $40,000 to $60,000 on the table every single decade by doing the exact same thing, just buying and holding the S&P 500. And I'm about to show you how sector rotation can fix that. I'm going to break down a strategy that's sitting right in front of you that nobody's talking about. And the crazy part? You can start with literally any amount of money in your Roth IRA or brokerage account. Here's the thing about the market that nobody tells beginners. The S&P 500 doesn't move as one. It's not like everything goes up together. Different sectors take turns leading the market. Technology crushes it 1 year. Then healthcare quietly doubles. Then financials wake up and everyone's surprised. The investors winning big money aren't just buying SPY and forgetting about it. They're rotating between sectors strategically. So let me show you exactly how to do this. Part 1. The sector rotation framework. Think of the economy like seasons. And every season has a sector that's about to boom. When we're coming out of a recession or slowdown, financials and energy start waking up first. Banks are ready to lend again. Oil prices are rising. This is your entry point. You're buying JP Morgan or XLE energy funds before everyone notices. Then as the economy gets stronger, industrial companies start crushing it. Manufacturing picks up. Shipping companies get busy. This is where Caterpillar or IYM Industrial ETF starts moving. Then, and this is where the big money comes in. Technology and discretionary consumer stocks take off during peak growth. Netflix, Apple, Amazon. These are household names everyone wants to own. By the time your mom is talking about buying Tesla, you should probably be rotating out of consumer stocks. Finally, when growth is slowing and people get nervous, they rotate into defensive sectors. Healthcare, utilities, consumer staples. These are boring companies making steady money. Coca-Cola, Johnson & Johnson, healthcare ETFs like XLV. This isn't complicated. It's literally rotating your money based on where the economy is in the cycle. Part 2. How to actually do this with real money. Let's say you have $25,000 in your Roth IRA with Fidelity or Robinhood. Here's your actual action plan. First, ditch the idea that you need to pick individual stocks. Most people aren't beating the market with stock picking. They're timing sectors. So use sector ETFs instead. These are funds that hold all the companies in one sector. XLK for technology, XLV for healthcare, XLF for financials, XLE for energy, XLY for consumer discretionary. These symbols are your cheat codes. Right now in 2024, we're in a slowdown phase. This means financials and healthcare are positioning themselves. XLV healthcare could quietly return 15 to 20% while everyone's obsessing over AI stocks. Here's the move. Split your $25,000. Put $8,000 into XLF for financials. Put $8,000 into XLV for healthcare. Put $5,000 into XLC for communication services. Keep $4,000 cash for opportunities. Every quarter, check where the economy is. Are we accelerating? Rotate into technology and consumer discretionary. Are we slowing down? Rotate back into healthcare and utilities. You're not day trading. You're repositioning every 3 to 6 months. Part 3. Why most people fail at this. The reason people don't do sector rotation isn't because it's hard. It's because they get emotionally attached to winners. Technology made people rich from 2016 to 2021. So when tech dipped in 2022, they held thinking it would bounce back immediately. It did, but they missed the gains everywhere else. Successful sector rotation requires discipline to sell winners and buy boring stuff. When XLV healthcare is up 18% and everyone's talking about quantum computing stocks, You need the guts to hold healthcare anyway if the economy is still slowing. Track the ISM Manufacturing Index. Watch the Federal Reserve interest rate decisions. Read earnings reports from major companies. You're looking for signals that the season is changing. When manufacturing starts picking up, rotate to industrials before the news cycle catches it. The realistic returns from sector rotation? If the S&P 500 averages 10% annually, smart sector rotation can hit 12 to 16% by being in the right sector at the right time. On a $25,000 portfolio, that's an extra $500 to $1,500 every single year. Over 30 years in your 401k or Roth IRA. That's the difference between having $2.2 million and $3.1 million. That's generational wealth territory. CTA. Start today. Open your Fidelity or Robinhood account if you don't have one. Buy one sector ETF that matches where you think the economy is heading. Then come back in 3 months and make your next rotation. This strategy works because you're not betting against the market. You're betting on how the market moves in cycles. And cycles always happen. If this made sense to you, hit subscribe. We're breaking down investment strategies that actually work every single week. Let's go.